Chairman, and thank you, Chairman, for being here today. I know several of my Republican colleagues have been asking you about Basel III and the potential for some changes, obviously, in capital requirements. I'm afraid part of what they're trying to do is fix a liquidity crisis at regional banks with a capital fix, which I don't think the two necessarily go hand in hand. In fact, it seems to me, while you've been trying to engineer a soft landing, and now have taken a pause, and I'm certainly not critical of that, I can't fathom why the Fed would want to raise capital requirements when we could be facing what's a credit crunch. And I mean, does that make sense to you that in a potential credit crunch with caused somewhat by higher rates, obviously somewhat by design, that it doesn't make sense to increase capital requirements for banks and individuals?
So I think that's always the trade-off, is higher capital means more stable, stronger banks that can last through bigger crises and things like that, but it's a continuum, because that also means slightly less capital being available and higher price of capital. So, and the thing with capital requirements is the answer isn't 0 and it's not 100. You've got to find the right place. I would also say that the capital in the form of the what I've been briefed on is a proposal where the big capital increases are really for the largest institutions, and much less so for institutions that are not among particularly the 8 G-SIBs.
But what's the motivation for that? I mean, you've just articulated the challenge, obviously, better than I did. But why the big, for example, the big institutions? What's the situation that would require higher capital requirements?
To your point, we spent many years raising capital and liquidity standards for the largest institutions, and appropriately so. I supported all of that, and I'm glad that I did. I think it's been warranted, and I think that the large banks have competed very successfully with this high capital. And I think further increases are going to be on the table. We always thought there would be some further increase at the end of Basel III globally, but I think it's going to be on the increases are going to need to be justified.
I'm going to get to another question, but you said something a little earlier that I wanted to get to in response to Senator Tester. Is your interaction with each other confined only to public meetings? Is that
not at all?
Okay.
Not at all. No, not at all.
So you try to persuade each other at the water cooler.
I talk to all my colleagues a lot. I can't. I'm not one of those people who can just sit in your office all day. I'm popping up and running around. I'm one of those people. So.
I see. Okay. Well, just because in your interaction, it sort of sounded like that, and I used to be in a 3-member, commission, not that regulated.
We have very regular meetings and conversations. Right through the weekend. We talk frequently.
Okay. In an earlier exchange with, I think it was Senator Tillis, you talked a little bit about digital economy challenges, and you're considering some changes to reflect, how quickly individuals can move money. And I mean, I think a lot of people would maintain that while you always need to have the foundation to weather the storm, so to speak, such as SVB, you might not even have a storm, but for the fast ability for somebody to spark a run, for example, or to move money quickly. But you didn't elaborate on what kind of changes you might be considering. Do you have some personal thoughts on it, or things that you've been talking about as you're running around talking to each other?
Yes. I'm not the biggest expert on this, but so
that's two of us.
The thing that's clear is that our existing liquidity requirements, they didn't take into contemplation at all the idea that you could have a run this fast. And so things are embedded in the net stable funding ratio and the liquidity coverage ratio that reflect an understanding of how fast a run happens. Mm-hmm. And we now learned that, so that's why I think there is regulatory response is going to be appropriate here, not just supervisory. In addition, you would have thought, and we thought, and by the way, the board is every bit as accountable as the San Francisco Fed on this, that supervision could have been much more forward-leaning on the liquidity issue than it was. And so we're going to address that too.
Yeah, no, great point, because these guys have heard me use my soccer referee illustration. If you warn the offender over and over and over, but never throw up a card, they just offend worse the next time. So I think that's an obvious finding, and I would concur with you. But the whole issue of the run itself is also problematic, while not maybe directly jurisdictional to any one regulator. As policymakers and regulators together, we should find a better solution. But I thank you again for your service and for being